From New York City, for our viewers worldwide, I'm Katie Greifeld in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, another sign that inflation is still very much an issue, which begs the question, can the Fed afford to slow down? And all as the primary market for corporate bonds goes dark. We begin with the big issue, though, the last week that matters.
We have CPI next week, and then we have the Fed announcement.
What are we going to hear from Chair Powell next week?
Inflation print will be very important.
CPI. We're watching the CPI numbers very closely.
Services inflation and wage inflation remains resilient.
Expect stickier core inflation in the U.S.
The bond market is telling you that inflation is a thing of the past and that the Fed has done too much.
They're trying to monitor how the economy is reacting to those hikes.
The Fed should be able to stop around 4.75 or 5%.
Now that the Fed is closer to pausing, inflation is starting to roll over. You're going to get those diversification properties from fixed income as well.
It's a good idea to own bonds.
We do believe that bonds are back.
Bonds are back.
A year from now, your yields are going to be even lower than they are today.
Stresses are going to come in the credit markets.
There's still a lot of question marks as to where inflation rates settle down.
Joining us now, we have Wells Fargo's Brian Rehling and Lotfi Karoui of Goldman Sachs. And Brian, I want to start with you because since Jerome Powell spoke on November 30th, we've seen a hot payrolls print, hot ISM services data, and now hot PPI just this morning. And when you add that all together, can the Fed afford to slow down right now?
Oh, I think so. I think they're going to go to 50. I mean, you have to remember there's quite a lag in the impact of monetary policy. So we're still cycling through a lot of these 75 still. So I see there's no reason to cycle down to not cycle down to 50. It doesn't mean they're stopping, doesn't mean they're pausing, but it seems appropriate.
Brian, is there anything that you could see on Tuesday when we get CPI that would change what we get on Wednesday?
I don't think so. I think the number comes in too late. The Fed really does like to communicate in advance to the markets. They don't like to surprise the markets. And so I'm pretty confident we're going to see 50, regardless of that CPI print.
Careful, deliberate communication. That seems to be the Jerome Powell Fed, at least for the past 2 years or so. But Lotfi, maybe 50 basis points in December is a lock. But when we think about the past week and a half or so, has the Fed's end destination for their rate hiking cycle changed at all?
We don't think so. I think the pace of the hikes is definitely poised to slow down. The final destination, however, is still the same. And so the question is really, what does that mean for markets? To me, the fact that we're starting this new phase with fewer of these jumbo hikes and a slower pace of hikes, that probably cuts the tail of a scenario in which actually we have a Fed-induced recession driven by over-tightening. So that's a positive thing. I do think the other shift is that rates volatility is poised to continue to slow down here, which is really good news for fixed income because it just allows outside capital to be deployed, particularly given the fact that we have a much better value proposition from a yield standpoint today. But the final destination, in my view, is still the same.
Okay, so a Fed-induced recession, I've heard that before, but you also see rate volatility cooling down maybe as we enter that recession. Can you square that circle a little bit more for me?
Well, I mean, the idea is simple. It doesn't matter how the cycle ends. The thing is we're getting a lot closer to the end of the tightening cycle than the beginning. And so once the countdown starts, I think you do slow down, basically, and you do dampen volatility in the rates market. Now, the question is, what are the pockets of the market that will benefit from that? I think a lot of the underperformance of this year, take as an example, the agency MBS market should continue to benefit. And in fact, agency MBS have performed very well as soon as rates volatility started to decline. The other example would be the front end of the investment grade curve from an all-in yield standpoint. Great sharp ratio if you sort of put a lid on that volatility. But to answer your question, I think it really doesn't matter how the cycle ends. I think the key here is that you are getting a lot closer to the end of the cycle, of the tightening cycle, than the beginning.
Well, as we talk about the potential for a recession, Romaine Bostick and I actually caught up with Chris Ailmans of Kelster earlier this week. Let's take a listen.
I feel like a recession has to happen because in my lifetime, when the Fed raises rates this aggressively, 75 time and time after again, the economy slows down. The inflation is from the supply chain disruptions and the war. Maybe inflation slows down on its own. I'd be surprised, but I think we got to have a recession.
And Brian, it feels like we've heard that up and down Wall Street this week, that a recession is coming. And if that's the case, does that help explain the rally that we've seen in the bond market over the past month and a half, or is there something else going on here?
No, absolutely. I mean, that's exactly it. Growth slows down. You tend to see those longer-term bonds do pretty well, and they've really ripped. They've done great since late October. So, yeah, I mean, a recession is, to me, basically a sure thing. It's the only way to bring inflation down. The Fed, the actions they're taking, I mean, it's on the doorstep, no doubt about it. I mean, the potential is it could even be here now. We won't really know till in hindsight, though.
And so we've seen a big gap open up in terms of the year-end forecast. This is the HSBC view that basically 10-year Treasury yields are going to end next year at 2.5%. Then you think about what we got out of Wells Fargo this week, that their expectation is that 10-year nominal yields should trade between 4.25, between 4.75 next year. So I don't know, just a yawning gap. Brian, where do you fall in between that range?
Yeah, I think we're probably in the middle there somewhere. I mean, I do think that inflation is going to stick around a little bit. It's going to be a little sticky. We might not see kind of the return to the 2% yields as quickly as next year, but also with growth slowing significantly next year, I think investors are going to be looking for more of those safe havens. Long-term fixed income typically sees flows during those periods. So, you know, trading somewhere in the mid threes makes a lot of sense to me. Wouldn't surprise me at times if we move above 4%. Would be adding duration as quick as I could during those periods when they do present themselves.
And Lotfi, I spent a long time going over that Wells Fargo call because we haven't seen 475 since about 2007 or so. But basically, the logic behind the call is that we're entering a period of structurally higher inflation. That should mean that a period of structurally higher policy rates should follow. Do you think we're heading into that sort of environment?
Yeah, I do. I think the higher for longer cost of funding environment is something that investors will have to come to at some point. But I sort of agree with the comment that was made earlier, which is recession fears has probably been the biggest driver of the very impressive rally that we've seen in yields. The other thing I would add is that there's probably a desire from a lot of investors to sort of re-anchor yields to the levels that prevailed pre-pandemic or between the post-global financial crisis period and the pre-pandemic period. That feels overdone to me. Now, of course, the fact that we're getting a lot closer to the end of the tightening cycle than the beginning probably means that the next leg higher in yields will be less about Fed policy and these front-loaded rates hikes, but it will be more about the resilience of the data. As you know, our baseline view is still for some kind of a soft landing scenario into next year. But if the data continues to hold up very well, and if the market comes to the conclusion that the most likely outcome next year is a pause as opposed to a pivot, then I think there's a case that you can make for yields to move higher again.
Well, Lotfi, let's work on that a little bit, because if the next leg higher is going to be fueled by resilient data, doesn't that raise the odds that the Fed will have to act even more aggressively to cool the consumer and just cool inflation?
It's a risk. I completely agree with that, and I think that's a great point, but it's certainly a risk that we've been keeping an eye on. But you know, one of the side effects of the fact that we passed peak inflation and that inflation is supposed to decelerate into next year is that real disposable income is supposed to rebound. And that poses a risk, upside risk to growth. And it could basically force another dose of tightening in financial conditions, because the necessary condition to bring inflation down is to keep growth below trends. And so every time you pose upside risk to that scenario, you sort of force a recalibration of the Fed's reaction function. But I agree that is a risk, yes.
And Brian, I want to end there with you on that sort of idea, the risk of over-tightening. Obviously, we know that the Fed is very concerned about that. But when we continue to get the strength in the data that we've seen over the last couple of weeks, does that risk become even more of a fear?
Yeah, I think so, because if there's one thing I have conviction on more than anything, it's that the Fed will be successful in returning inflation back to a level they're comfortable with, clearly sub 3%. So if the inflation data remains elevated, then the Fed's going to remain elevated. I just don't see them capitulating at any point until they win. They just have their entire credibility on the line here.
Guys, great conversation. Brian Rehling and Lotfi Karoui are both sticking with us. Up next, it's the auction block. December, it's been chilly for issuance. Those bear numbers next. This is Real Yield on Bloomberg. I'm Katie Greifeld in for Jonathan Farrow. This is Bloomberg Real Yield. Time now for the auction block, where the word of the week and probably the month is slow. We start in Europe. Primary market participants think the holiday season is already here. That group coming to a standstill this week with no new deals pricing yesterday or today. Over here in the U.S., you have the same story. Weekly volume at just $4.3 billion. It's lining up to be the slowest December in at least the last 15 years. If you are looking for some activity, though, you have to go to sovereigns and back to Europe, where Barclays sees European government bond net issuance rising to nearly 500 billion euros in 2023, a record high. That's as the ECB pivots away from QE. When it comes to credit, Chris Sheldon over at KKR is sticking with it now.
The market is so fragile right now, where I think waiting can be a dangerous game. I think starting to strike now is the way you should be thinking about credit. And if we're at a higher resting heart rate for rates for a long period of time, valuations are going to be lower. Credit seems really attractive relative to equities. And the market essentially is set up almost like a tinderbox ready to explode. So, because when there is consensus, when there is conviction there, a lot of cash is on the sideline that will step in, and there's not a lot to buy.
Brian Rehling and Lotfi Karoui still with us. Lotfi, not a lot to buy. Do you expect that supply dearth to continue into next year? And if so, is that a tailwind?
Absolutely. It's been a tailwind throughout the year, particularly in the high-yield bond market, where we've had a spectacular adjustment on the supply side. But we're on track to finish the year down 80% relative to last year in terms of gross new issue volumes. Net supply is probably going to finish the year negative 10% of the total amount outstanding. So think about it this way. The market has essentially contracted by 10%. I do think that later into 2023, you should see some normalization in primary market activity, driven entirely by refinancing needs. Again, if you look at the dollar high yield market, the maturity wall sort of kicks in 2025. The typical issuer, on average, comes to the market a year to a year and a half before the maturities come due. And so, mechanically, that probably sets us up for a little bit of a rebound in the second half of 2023. Relative to historical standards, however, particularly 2020 and 2021, I think the recovery is going to be slow.
Well, Lotfi, before we get to next year and the outlook there, I want to go back to this year and the fact that credit spreads have been as resilient as they are, because I've been looking for an explanation when you look at the volatility that's going on in the Treasury market, why credit spreads have been so unbothered. Does that come back to that supply story?
I think there's a number of reasons. Technicals have been a big driver, no question about that. Everyone going into the year was focused on the demand side of the equation and the prospect of a slowdown there. We've had, I think, if you look at flows, they haven't been that impressive. But a lot of that has been offset by the, big adjustment that we've seen on the supply side. So that's one. I also think that fundamentally, credit doesn't have a problem. What you can look at things at the sector level, at the issuer level, irrespective of what will happen into 2023. I do think that we're going into it in a position of strength. And I think that fundamental strength that's been visible in, liquidity positions, declining leverage, et cetera, has provided a lot of stability to the market. Maybe third factor, and I think a lot of the speakers have alluded to that already, the return of income in fixed income markets has been a big driver of that resilience too.
Well, let's talk more about the fundamentals, because there was a Bank of America note that caught my eye this week. I'll read you the quote. For the market overall, we agree and look for resilient IG fundamentals as earnings are supported by inflation and management continues to reduce debt. However, the lack of stress indicates another kind of uncertainty. Something typically breaks in a recession. At this point, markets do not know what that is going to be for IG. Brian, come in on this point. The fact that there is no stress if you look at the credit markets, is that something to worry about?
I would keep a close eye on it for sure. As we go into next year, again, I have a view we're going to have a recession. I have a view that earnings are going to probably be a lot more challenged than people expect. And so, fundamentally, I think people at some point are going to sell credit. Typically in every prior recession, we've seen high yield credit spreads hit almost 800 over, and we're sitting around 450 now. And so I'm not sure we're going to hit 800 because of the yield, of the income, of the demand there. So I do agree those fundamentals are much stronger than we may have seen in the past. But surely 600, 650, something like that would be an entry point. I'd get a lot more aggressive in terms of credit. But again, this is all predicated on my view that, a recession is basically on the doorstep.
Well, Brian, you hit on something that I've been wondering about over the past couple weeks, because to your point that if you look at past periods of recessions, you've really seen spreads blow out, obviously not happening here. So if 650 maybe is the entry point, do you expect the default rate to rise as well?
Yeah, sure. I mean, it lags, of course, but as we go into a recession, earnings are challenged. Now, companies are better positioned in the sense that they, took care of a lot of those funding needs. But ultimately, especially at the lowest credit quality down, the lower end of high yield, the CCC type names, yeah, I think those are going to be quite challenged in the economic environment, I think, that is coming.
And I want to compare and contrast here and talk about the relative value between IG and high yield. Lotfi, when you compare the two rating tiers right now and you think about the Fed-induced recession that you say that we're heading into, which is the better opportunity at this point?
Well, just to be clear, our baseline assumption is still for some kind of a soft landing. So a recession is not what we're forecasting next year. Look, I do think that, we've witnessed the fastest and most pronounced increase in the cost of capital since the onset of the Great Moderation, pretty much. Second thing to keep in mind, we've had a very different hiking cycle from anything we've seen in the last 3 decades. We've had a Fed that has been hiking and will continue to hike into a slowdown. We have an ECB that's been hiking into a recession, which was unthinkable only 4 quarters ago. And so to me, that's an up in quality world, and that leaves me more constructive on IG versus high yield, because all else equal, the bigger you are, the more financial flexibility, the more operational agility you have, the better position you are to withstand this transition towards a higher for longer cost of capital environment.
Well, Lotfi, if a soft landing is the base case, I want to blueprint a little bit what that looks like. If we do get a soft landing, and it seems like the path is getting more narrow by the day, what happens to spreads? What happens to defaults?
I think what happens is probably some rebuild of risk premium in the first half of the year as the market continues to navigate that uncertainty. There are a lot of constraints on how tight spreads can go to, the fact that continue to lean against any excessive easing in financial conditions, et cetera. But second half of the year, if that soft landing path becomes visible, I think you will see some compression in risk premium and probably tighter spreads.
And Brian, I want to get your thoughts on that, both the idea that maybe a soft landing still is in the cards. And if that's the case, what do you buy?
Well, I mean, I would be very surprised if we had a soft landing. The yield curve, I mean, there's just so many signals to me that suggest it is a far case. But if we would have a soft landing, well, then it's risk on, right? I mean, if we avoid a recession, you know, I mean, it's just risk to me, buy risk, wherever it looks like. I mean, because there is a lot of demand out there. There's pent up energy. You just see it every time the equity market just pulls back a little bit. There's buyers there. There's buyers there. Any hint that the Fed's going to slow down or pause, buyers come in. So the buyers want to be there. So if truly we don't see the fall off in earnings, we don't see a recession, then yes, I mean, you want to be buying, to me, the riskiest assets and are going to have the best returns. But again, that wouldn't be my expected case. I expect that we are going to have a recession. I would be still at this point being more defensive. If I'm doing anything offensively right now, which we started doing back in October, it's adding duration, especially when I see, you know, 10-year up at 4% or higher. Those are the areas where I'd be offensively adding duration. Other than that, I'm in a very defensive posture.
On the offense in the long end, Brian Rehling and Lotfi Karoui staying with us because still ahead, it's the final spread. The week ahead, it's the global central bank Super Bowl. This is Real Yield on Bloomberg. I'm Katie Greifeld in for Jonathan Farrow. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, it's a big one. We have the big U.S. inflation print coming on Tuesday. Then finally, it's the Fed decision, followed by Chair Powell's news conference on Wednesday. And then a host of rate decisions on Thursday, including the BOE and the ECB, and a news conference followed by President Lagarde. And finally, wrapping up the week with PMI and CPI data out of Europe. But it's time now for the rapid fire round. We're running out of time, you guys. But Lotfi, let's start with you. I think I know the answer. Can the U.S. economy avoid a recession?
Yes.
Brian?
No.
Does the 2s-10s curve uninvert next year, Lotfi?
Yes.
Brian?
Yeah, by the end of the year, yes.
Credit spreads tighter or wider this time next year, Lotfi?
Modestly tighter.
Brian?
Wider.
All right, you guys, Brian Rehling and Lotfi Karoui, thank you both so much for your time from New York. That does it for us. Same time next week. This was Bloomberg Real Yield. This is Bloomberg.